Have you ever wondered how to invest in bonds like a pro? Well, you're in the right place to start unraveling that mystery. Bonds, my friends, are one of the most essential tools in an investor's toolbox. They are the bread and butter of a well-diversified portfolio, offering a stable and predictable return on investment. But what exactly are bonds? In essence, when you buy a bond, you are lending money to an entity, be it a government or a corporation. In return, they promise to pay you back the money on a certain date along with interest. It's like being a bank, but with a twist. You can sell the bond to someone else before it matures, potentially making a profit if its value has increased. Now, you may be wondering what this has to do with the art of dental finance and management. Well, investing in bonds is not just about making money. It's about managing risk. For a dental practice, or any business for that matter, bonds can provide a steady stream of income to help meet expenses, even in a turbulent market. Bond valuation, on the other hand, is the science of determining the fair value of a bond. It's a bit like appraising a house. You look at the interest rate, the creditworthiness of the issuer, and the length of time until the bond matures. This helps you decide whether the bond is a good buy or not. Why is this important? Because understanding bond valuation can help you pick the right bonds for your portfolio. Whether you're a beginner or Peter Lynch himself, it can help you make smart decisions, not just in the bond market, but in the stock market too. So whether you're considering your first investment or you're a seasoned investor looking for a refresher, mastering the basics of bonds is a crucial step. From understanding the initial value of an investment to calculating the final and current value, bonds can be your path to steady returns in a volatile world. Understanding bonds is the first step towards mastering the art of investing. So let's dive deeper into the world of bonds and start investing like a pro. Bond valuation might seem complex, but with the right guidance, it becomes a walk in the park. So let's unravel the art of bond valuation together, shall we? Bond valuation is the process of determining the fair price or value of a bond. It takes into account several factors such as the bond's face value, market interest rates, and the time until maturity. Why is bond valuation important, you ask? Well, it helps investors like you and me make smart decisions. If the current market price of a bond is less than its calculated value, it can signal a good investment opportunity. Similarly, if the market price is higher than its value, it might be wise to sell the bond. Now, let's talk about the current, initial, and final value of investment. The initial value of investment is the amount you initially invest in a bond. The final value, on the other hand, is the amount you expect to receive at the bond's maturity, including the interest payments. The current value of investment, however, is a bit trickier. It's the present value of the bond's future cash flows, discounted at the current market interest rate. For instance, if you have a bond that pays $10,000 in 5 years and the current interest rate is 5%, the present value of the bond will be less than $10,000. And this is where the concept of yield to maturity comes into play. It is the total return anticipated on a bond if it is held until maturity. Yield to maturity is considered a long-term bond yield, but is expressed as an annual rate. In contrast, yield to call applies to callable bonds, which are bonds that the issuer can redeem before they mature. The yield to call is the total return that would be received if the bond is called prior to its maturity date. Bond valuation is a crucial skill in investing, whether you're a beginner or a seasoned investor. So, like Peter Lynch, let's keep learning and investing smartly. After all, the world of bonds is full of opportunities waiting to be seized. Picking the right bond can make or break your investment strategy. That's a powerful statement, isn't it? But it's also a true one. The art of dental finance and management, or any financial management for that matter, is all about making smart, informed decisions. And when it comes to bonds, the decision-making process begins with picking the right ones. Let's take a page out of Peter Lynch's book, shall we? Lynch, a renowned investment guru, has a nugget of wisdom that applies perfectly to beginners looking to invest in bonds. He suggests that you should invest in what you know. Now, this doesn't mean you should only invest in bonds issued by your employer or your favorite fast food chain. It means understanding the business behind the bond. You see, every bond is issued by an entity, be it a government, a municipality, or a corporation. Understanding the financial health and stability of this entity is crucial. You wouldn't want to invest in a bond issued by a corporation that's on the brink of bankruptcy, would you? So, your first step in picking a bond is understanding the issuer. Next, let's talk about valuation. You'll hear terms like yield to maturity, yield to call, and present value thrown around quite a bit. These are all methods of bond valuation. In simple terms, they help you determine if a bond is priced fairly. But don't worry, you don't need to be a certified public accountant to understand these concepts. There are plenty of CPA exam review courses and resources available that can help you grasp these fundamentals. Lastly, consider the initial, current, and final value of your investment. Remember, investing in bonds is not about quick gains. It's a long-term strategy. You're lending your money to the issuer for a certain period. You want to ensure that your investment grows over this period and that you're adequately compensated for the risk you're taking. Choosing the right bond is just as important as understanding its valuation. So, take your time, do your research, and make informed decisions. After all, your financial future depends on it. Corporate bonds and stocks are two sides of the same coin. Both offer unique opportunities for investors. Let's dive into the world of corporate bonds first. These are essentially loans, where you as the investor act as the lender to a corporation in exchange for periodic interest payments and the promise of repayment of the bond's face value at the end of a specific period. Now, investing in corporate bonds doesn't have to be complex. It's a matter of understanding the basics and taking the right steps. Start by researching the company, its financial health, and the terms of the bond. Look at the interest rate, the maturity date, and the credit rating of the bond. The higher the credit rating, the safer the bond tends to be. Next, determine the bond's yield to maturity, which is the total return you'll get if you hold the bond until it matures. Keep in mind that a higher yield often means a higher risk, so balance your desire for returns with your tolerance for risk. On the other hand, stocks represent ownership in a company. When you buy a company's stock, you're buying a slice of that company, including a share of its profits. Investing in stocks can be as simple or as complex as you want it to be. You can choose to invest based on a company's fundamentals like its earnings and growth prospects, or you can follow the trends in the stock market. Take McDonald's, for instance. Its valuation isn't just about the number of burgers it sells, it's about the company's growth prospects, its competitive position, its financial health, and the broader trends in the food industry and the economy. Finally, whether you're investing in corporate bonds or stocks, remember to diversify your investments. Don't put all your eggs in one basket. Spread your investments across different companies and sectors to reduce risk. Investing in corporate bonds and stocks can be a rewarding journey if navigated correctly. So take the time to learn, plan your strategy, and make informed decisions. The world of investing awaits you. Now that you have a grasp on bonds, let's dive into the world of stocks. Stocks represent ownership in a company and come with their own set of rules and strategies for investment. Just like with bonds, investing in stocks requires a thorough understanding and analysis of the company you're investing in. Let's start with the basics. The stock market is a vast ocean of opportunities where fortunes are made and lost every day. To navigate this ocean, you need a compass, a map, and the courage to face the unknown. Your compass is your understanding of the financial world, your map is your strategy, and your courage comes from your willingness to take calculated risks. So how do you invest in the stock market? It starts by researching potential companies to invest in. This involves looking at a company's financial health, the stability of its industry, and the competence of its management team. The more you know about a company, the better your chances of making a smart investment. Once you've done your research, it's time to make your move. This involves buying shares of the company's stock. The price you pay for each share will depend on the company's current valuation. This is determined by a variety of factors, including the company's earnings, its assets and liabilities, and the overall health of the economy. But investing in stocks isn't just about buying low and selling high. It's about understanding the market, knowing when to hold onto your shares and when to sell. It's about being patient, staying informed and making decisions based on logic, not emotion. For those preparing for the CPA exam, understanding stocks and bonds is crucial. These concepts form the backbone of many questions on the exam, and a strong grasp of them can greatly improve your chances of passing. Investing in stocks, like bonds, is an art that can be mastered with the right tools and guidance. It's not about getting rich quick, but about building wealth over time. It's about taking control of your financial future and making your money work for you. So take the plunge, start investing, and watch your wealth grow. Watch